Liabilities. Current liabilities are obligations that will be settled within 1 year or one operating cycle, whichever is greater. Typical liabilities, current liabilities include accounts payable, notes payable, current portion of long-term debt, any taxes that are payable, accrued liabilities, unearned revenue. And then, as we've discussed before, long-term liabilities are liabilities that are due after 1 year or after one operating cycle. Now, so owner's equity, as we've discussed before, owner's equity is simply equal to the total value of your assets minus the total value of your liabilities. So the interesting part with owner's equity is to understand the categorization or different parts of owner's equity. Contributed capital is the total amount paid in by the common and preferred shareholders. So this essentially means that if the common and preferred shareholders invested $100 million, then that is the contributed capital. This is the money that was contributed by the shareholders. Retained earnings are the cumulative earnings not yet paid out to shareholders as dividends. So let's say that this company has been in business for 5 years, and the last 5 years the company has made profits of 15 million, and from this 15 million, 5 million has been paid out as dividends. So retained earnings is 10 million in this case. Why is it 10 million? Because total earnings were 15, 5 million paid out to the shareholders, so what the company has retained is 10 million. So the retained earnings are also a part of owner's equity. You can think of it as follows, that the earnings belong to the owners of the company. If they don't take that money out in the form of dividends, they have essentially and effectively put their money back in the business, and hence retained earnings are a part of equity. Minority interest is the minority shareholders' prorated share of net assets of a subsidiary that is not wholly owned by the parent, and I will explain this in the next couple of slides. And then we have other comprehensive income, which I will also explain shortly. Owner's equity, when we talk about different kinds of shares, you need to understand this. When you see authorized shares, these are the number of shares that can be sold under a firm's article of incorporation. So when a firm is incorporated, it might say that the number of authorized shares is 10 million. So these are the total number of shares that can be sold. Issued shares are the number of shares that have actually been sold or issued. So of the 10 million, let's say that the company has actually issued 6 million. Outstanding shares are issued less number reacquired by the firm. So reacquired means when the company does something called a treasury stock operation, the company is buying back or reacquiring some shares. So let's say that the company has done a treasury stock operation for 2 million shares. Then the number of shares outstanding would be 6 million, which was the number originally issued, minus the shares reacquired through the treasury stock operation, which will give us 4 million. So this is an example of a treasury stock operation. Notice that the treasury stock operation reduces shareholder equity. So when a company issues new shares, that increases shareholder equity, because issuing new shares means that shareholders are putting more money into the company. Treasury stock operation means that the company is paying money to shareholders, so money is leaving the company, and hence that reduces equity.